Hi, I'm Justina from Practices Academy. This is the third and final video of our costing method series. And in this one, Neesha covers three concepts that go beyond traditional costing: activity-based costing, lifecycle costing, and target costing. These are widely used in real businesses and examined across multiple accounting qualifications, whether it's ACCA, CMA, or any other. They are more conceptual than the previous two videos, so no complex calculations here. What matters is understanding how each method works and why it differs from traditional absorption costing. Activity-based costing uses specific cost drivers rather than a blanket absorption rate. Lifecycle costing looks at how costs and pricing change across a product's life, and target costing flips the traditional process entirely. You start with the selling price and work backwards to what the cost needs to be. Over to you, Neesha.
Activity-based costing is an modern alternative to absorption costing. So in absorption costing, we absorbed overheads based on maybe labor hours, machine hours, and so on. So we had specific drivers to absorb overheads. But sometimes they were not specific to the overhead cost we're talking about. So they were not as accurate as they could be. But the difference in activity-based costing is overheads are absorbed based on their specific cost drivers. So therefore, we may use multiple cost drivers. For an instance, the overhead production setup cost, we understand what will drive this cost. So production setups are driven by the number of production setups. So that will be the cost driver. Then machine oil, machine repairs will be driven by number of machine hours. How long do we run a machine? Supervisor's salary will depend on how many hours he or she works, so the number of labor hours. Similarly, if you look at even the latter two, we look at the overhead, then we identify what really drives the cost for this overhead when we decide on the overhead absorption driver or the rate we're going to use. So therefore, it is similar to, it's not entirely different. The concept of activity-based costing is a further step forward from absorption costing. So if we have absorption costing, activity-based costing or ABC is a step further. So what are the steps of activity-based costing? One is we need to identify the relevant overhead costs. So group overheads into cost pools. That means identify cost in relevant areas. Then we identify what drives cost. So one is cost pools. We put overhead cost into cost pools. Then we identify what drives it. Then we calculate the cost per unit of each cost driver, and then we absorb it to individual products. So identify overhead costs, put them into cost pools, then we identify what drives them, then we allocate them to cost units, we identify the cost per unit of the driver we identified, and then we absorb them into individual products. Now, the difference between activity-based costing and traditional costing is activity-based costing is more detailed. It really explains, it links the absorption rate along with what drives cost. So it's more closely related to a more accurate costing of products and therefore better decision making, better pricing of products. At the same time, it recognizes that overhead costs arise. They're different from each other, they are complex, and therefore will require different cost drivers when determining overhead costs and not just one. At the same time, when we use activity-based costing, we do not have to reapportion service department cost. Why? because in the first time itself, we identify the relevant cost driver for it and we allocate it. So no reapportionment is needed using activity-based costing. So these are the fundamental differences. It's just a more refined approach to absorption costing. So you will learn absorption costing in more detail as you go through the ACCA syllabus. So that is a touch on activity-based costing. Next, if we look at life cycle costing. Now, life cycle costing is, we identify here, this is of course most relevant to a product being produced. We identify that a product might have a life cycle. For an instance, if you think of a brand of a phone, it first is developed in the factory, developed by the company, then it is introduced, then people start buying that phone. Then we come to a stage where quite a lot of people have that phone. There are newer models coming into the market. We don't really see an increase beyond that. And then we see a decline. Now there are a lot more newer models, a lot better phones out there, better features out there. So we see a decline. And that's the life cycle. I give you, for an example, take products such as the floppy disk we had many years ago, maybe when you were younger. The floppy disk, if you look at the life cycle, it's declined. We don't see anyone buying floppy disk anymore. Why? Because it's not usable anymore. You have things that are much more advanced. Maybe the pen drive. But the pen drive now also is at the decline stage. People are now starting to use the cloud. So you can see even in a particular industry, you'll have different products at different stages. For an example, maybe pen drives will be at decline, cloud will be at growth. So there, or maybe you might even allocate pen drive to maturity. I might put the floppy disk over here because I don't think anyone uses it, so it has already declined, or it has already, demand has fallen, people don't use it anymore. So based on these 5 stages of sales and profits and product growth, a company can charge different prices for its product, or cost will also change. For an example, at the development stage, cost will be research and development cost, or we can say R&D cost. Then at introduction, we will have a high amount of fixed cost because we just started, we're not selling much units, very low levels of sales, so fixed cost will be high. At growth stage, we have fairly started to cover our fixed cost, but the main cost will be from our variable cost. We'll see increases in variable costs. And now at maturity stage, our main cost, because we have most likely we have covered all our fixed cost. Our fixed cost may be our research and development cost, initial cost of purchasing machinery to produce this product. So all of this is covered because we sold enough units at growth. So maturity stage, you have a stable and high volume of sales. Your main cost primarily is variable cost. Decline stage, your demand starts to fall. Again, your primary cost is variable cost. You might have some fixed cost. For an example, if you decide to stop manufacturing this product, this brand, you might have decommissioning cost, which you will have to incur. So that will be an aspect of cost. So therefore, if you're thinking of pricing, if we try to link costing with pricing, at the introduction stage, we might, depending on the product, we might either go for a low price. So that might be penetration pricing. So this is not really relevant, but penetration pricing, or in other words, low price. Or we may go for a high price at this stage. So price skimming. Depending on the product. If it's a very high-tech product, we might go for price skimming. Normal product, we might go for penetration pricing. At the growth stage, again, our pricing strategy may change. As more people want it, Depending on the product, we might either increase our price. If it's a standardized product, we might be able to increase our price if we use penetration pricing at first. If it is a tech product, as more people buy it, we might reduce our price because adoption is more. So we can charge different prices at different stages of the product life cycle. Similarly, cost will also differ. We'll have very high cost at development introduction stages. Growth to decline cost tends to mainly be variable cost. Fixed cost is covered. Cost starts to decline. Therefore, we can charge a lower price from customers. So that was one aspect of costing, life cycle costing. Might not be applicable to everything, but like I mentioned, when life cycle costing might be used. Then we have target costing. Now, target costing is basically deviating from traditional costing. Because here we are talking about, first of all, identifying the selling price we want to charge our customer. How much do we want to charge our customer in terms of the selling price? So in a traditional costing, we first identify the cost. Then we identify the margin or the markup. Then we identify the selling price. But in target costing, our first point is we identify how much do we want to sell this product if we want to achieve a particular goal, maybe to get market share. So that goal might be market share. So therefore, based on that, to secure market share, to secure profits, we might decide on a target selling price. Then, based on that target selling price, we determine the margin and the target cost. So that's a more modern approach to costing compared to the traditional approach to costing where we determine the cost, then the markup, then the selling price. So, therefore, if we are going to follow target costing where we determine the selling price and then we have a target cost we need to reach. So therefore, we need to identify aspects we need to consider to achieve this target cost. So therefore, we might talk about things such as cost cutting. What do we need to do to cut cost? So to cut cost, we might remove parts of the product, features of a product that might be unnecessary or not very value adding. They are, but not needed. We might re-engineer the product a little bit to decide what kind of materials we're going to use to eliminate or minimize cost. Of course, we need to remember that quality value needs to be kept. Quality or value needs to be kept. We cannot compromise quality. We cannot compromise value in order to meet the target costs. So, quality of the product, value of the product should be kept. However, we can make adjustments to cost based on identifying whether we are offering something that customers may not necessarily need. We can remove that off to eliminate that cost. We can re-engineer our product using different materials as long as the quality is maintained. So, therefore, practically speaking, we might have a cost gap. Now, the cost gap is filled using these two aspects or using aspects to cut cost. So, that's basically all about target costing. So, we must make efforts to close the cost gap. So, to do this, we might aim to make design out cost before the production starts. So, this is where before beginning to produce, make changes in design so that we can meet this target cost. Changes may be re-engineering the product, removing unnecessary features to meet the target cost. So that's a simple gist of target cost. Remember, with target costing, we start with the selling price, then we determine the margin, then the target cost. So it's opposite to the process we would follow using traditional costing. So this brings us to an end of our lesson. So this lesson was fairly a simpler lesson. We discussed how to cost for a job or a batch costing system, how to determine the pricing. Then we also discussed a little bit about the characteristics of service costing. And now we spoke about 3 concepts of costing: activity-based costing, life cycle costing, and finally, target costing.
That wraps up our costing method series. The big idea across all 3 videos is that there's no single right way to cost a product or service. The method depends on what you're producing, how it's produced, and what decisions the cost information needs to support. That's the kind of thinking that matters both in exams and in real business. If you are studying for ACCA or CMA and you want to practice these topics with exam-style questions, our question bank is linked in the description. And if you found this series useful, we'll try to cover more later in the future. For example, variance analysis. Please give us a thumbs up, and till the next one!